Hey everyone, welcome back to the channel. In this video, I want to talk about a category of stocks that I think has great upside over the next few years. This is a basket of stocks that have been underperforming for a better part of this year. And I think that because of this, a lot of names in this category have traded down to levels that make them look very attractive compared to the rest of the market. So stay tuned to hear what kind of stocks I'm talking about. Now, if you find some value out of today's video, make sure you leave a like on this video and subscribe to the channel if you want to stay up to date with all of the content I post in the future. And as always, you can let me know your thoughts on these stocks down in the comments. So let's get started. So the stocks we're going to talk about today are South American companies, and specifically I've been looking at the countries of Brazil and Mexico. Now, Brazil and Mexico are commonly referred to as part of the emerging markets. These are countries that are experiencing fast growth. They have a large amount of the population rapidly increasing their standard of living. A lot of these countries are becoming more politically stable. And so all of these factors provide a nice foundation for the companies in these countries to really do well. So what I have up now is a chart of these stock markets compared to the S&P 500. So the bar chart is the S&P 500, obviously outperforming. And then the blue line is the Mexican stock market. The orange line is the Brazilian stock market. And both of these markets have been underperforming the US since the beginning of last year. And if we even take a look at the last 6 months of this year, Brazil's stock market has been trending down, and Mexico's has stayed pretty flat, even as the S&P 500 has been climbing. Now, even though most economies around the world are in full-on growth mode again after the lockdowns of last year, there are a number of factors that have been pushing down some of the stock markets in South America. And so here's an article I found about that, talking about a vicious cycle dragging down Mexico's stock market. And so what's happening is the stock market in Mexico is sort of drying up, where the number of stocks with $10 million of daily trading volume has fallen by almost half just in the past 3 years. And so even though countries like Brazil, Hong Kong, and the US has seen record new listings this year, Mexico's stock market has been shrinking as interest from both local investors and foreign investors has fallen. And so this is sort of a cycle where you have less demand for investment in these countries. That means these companies are going to be even less liquid, with lower daily volumes, and so that in turn even makes them even less attractive to outside investors that value that liquidity. And so here you can see a chart of stock volume in Mexico, and it has been steadily declining since 2010. And so part of this is the apparent attractiveness of other emerging markets. Countries, most notably in the news right now, is China. That is where a lot of the attention is for foreign investments. And so that sort of leaves countries like Mexico and Brazil out of the picture. You can see here how the weightings of Mexico and Brazil have fallen in this emerging markets index as the share of China's companies has steadily risen. Now, another reason for the underperformance in Mexico and Brazil is that both of their currencies have been losing value at a pretty fast rate. So somehow the United States dollar has been strengthening over the past few months. And so what that means is Mexican companies become less attractive when the Mexican peso loses value compared to the dollar. And so the expectation that the Fed is going to begin raising interest rates, along with inflation being high in Mexico, where they had inflation of 8.5% last year, that means Mexico's currency is going to devalue compared to the dollar. And so this is an important thing to know. As if you're investing in any emerging market, the value of the currency is something that can eat away at your gains. And there are different ways to mitigate these risks. You could always do something like hedge the currency. You could always go in the foreign exchange markets and hedge the currency of the company you're buying. So there are ways to get around this risk, but it is a risk to know. And so again, Brazil's currency, the real, is also losing value. And again, the Mexican peso is losing value after it's estimated that November's annual inflation could top 7%, which would be the highest in 20 years. So now we are going to take a quick second to talk about the massive upside of investing in countries where no one else wants to invest in. Now, there are a couple of brothers from New Zealand, the Chandler brothers, who have amassed an incredible track record by doing just this, by investing in emerging markets where no one else wants to be. And the Chandler brothers, over the life of their fund, had investment returns better than pretty much any of the well-known value investors. So over the 20 years of their fund, the Chandler brothers returned a 36% carry average growth rate. That's higher than Warren Buffett, Seth Klarman, and Peter Lynch, all the classic value investors that are most popular for their outperformance. The Chandler brothers performance blow most of them out of the water. And over a 20-year period, which is not insignificant either. Now, the Chandler brothers are pretty secretive. They stay out of public as much as possible, but I did find this one article really detailing their journey and their investment process. So I'll put a link to this article down in the description. And so here's just a list of what they did. They were among the first investors to plunge into emerging markets like Russia, Brazil, and the Czech Republic. And so their investment strategy was to go to whatever country was currently having a panic and invest in a low number of concentrated bets. And so one of their first investments was when they went all in on Hong Kong commercial real estate in 1987. This is when the Hong Kong real estate market was completely crashing. The prices were down 70% from their peaks. Here's some news articles from this time period. There was also plenty of political instability, and so this investment worked out incredibly well for just over 4 to 5 years. Another investment they made was in Brazil when inflation was high and no one wanted to invest in Brazil. The Chandler brothers went in with a concentrated bet. And as you can see from this chart, right, they bought the major telecom company in Brazil, and so they 5x their initial investment in under 3 years. Another big investment they made was on Japanese banks in the early 2000s. Again, here are the news articles at the time. Japan's in a banking crisis. They have a sick banking system, and so again, they made these investments, and it paid off with a 10x. In this name, Mizuho Financial Group. So there's more to this article, but that is the main point. These two brothers went heavy into countries where there was panic, where there was instability, where everyone thought you'd be crazy to invest there, and they made big bets that paid off extremely well. Now, this doesn't mean everyone should go invest in, third world countries. You can't just go to these countries and just buy anything and make money. Most of them are going to be losers. But I do think that if you look into an unattractive country with sound investment principles, I do think there are opportunities for outsized returns. So now I'm going to share with you 3 companies that I'm looking at in Brazil and Mexico that I think look like attractive investment opportunities. Remember, this isn't financial advice, but these are 3 companies that I'm keeping my eye on, and if they keep falling, I'm likely to enter a position into at least one of these names. So the first company's name is Betterware de Mexico. Their ticker is BWMX, and this company is a direct-to-consumer product company where they sell home solutions, kitchen, food preservation technology, and mobility. So you can basically think of them as a Mexican Tupperware. Now, they do have a multi-level marketing business model, which is a controversial yet effective business model. And so if you take a look at the stock price, it has plummeted over the past half year. It was at $50. Now it's sitting at just above $23. And so what happened with this company is really the growth expectations got way ahead of themselves. So this company went public as a SPAC in 2020. They had massive growth in 2020. We're talking 200-300% revenue growth. And the problem was that investors were expecting that growth to continue indefinitely. And obviously nothing grows forever. And this year, the company has had a couple rough quarters where their revenue has essentially stayed flat. And that has caused investors to panic. All of these investors thinking revenue is going to keep growing at 50% a year. They're now panicking and selling out after seeing 2 quarters of flat revenue growth. However, I think this company is attractive. I think the global supply chain issues and the issues with their sales force are going to work themselves out over time. And this company also looks cheap on valuation. They're trading at 18 times earnings. They have a very low amount of debt, and they also pay a dividend. Right now the dividend is over 9%. Obviously, you're not going to find that anywhere else. This dividend does seem sustainable. However, the thing to know is that it is paid out in the Mexican currency. So depending on the exchange rate with the dollar, this dividend will go up or down. Now, just to take a look at the sentiment with this company, I searched up the ticker on Twitter. I do this once in a while to get the sentiment on a certain company. And so most of it has been pretty negative. So here's a couple of tweets that I found. Here's this one from today, bailed out from BWMX, uninteresting story, declining coverage, macro headwinds, poor investor relations. All right, obviously this person has lost interest in the company and is selling out. Here's another tweet that I found about the company, that 3x growth is in the past. Increasingly likely that sales decline and the big chunk of historical growth is revealed as a one-time COVID boost. So it seems like all these investors that were expecting 50% revenue growth, right, they see a couple quarters of no growth and think that the 0% growth is going to stay indefinitely. However, when I look at the situation, I think the company is going up against extremely tough comps from the third quarter last year, and add into it, and this is a physical product company. All companies are having trouble right now sourcing their product, and that is going to lead into these lower revenues as well. Now, if we look at the valuation of this company, they do look attractive. So this is gurufocus.com, and we're going to look at the reverse discounted cash flow model. This flips the traditional DCF on its head, where instead of getting a target price from the expected growth rate, the reverse DCF takes the current price and tells you what the consensus expectations are for growth to justify what the current price is now. And so if we take a look for BWMX, the expected earnings per share growth rate is 4%. And so this seems exceedingly low. Obviously, the company grew 200% last year, right, due to a one-time event. Obviously, 200% growth isn't going to continue, but I do think the company is in a position to grow at a much faster rate than 4%. I think next quarter is going to be rough as well, but I think next year the company should grow at least 10%, potentially even 15 to 20%. And so if that growth can't sustain over the next few years, then this company is a bargain at this price. Now, the next company is the Brazilian company StoneCo. Their ticker is STNE, and they are a fintech payments company in Brazil. You can sort of think of them as the Square of Brazil. Now, this name got some popularity when it was noted that Berkshire Hathaway bought into the company on the IPO. I don't think it was a Warren Buffett investment, but either Ted or Todd who make investments under Berkshire Hathaway probably bought into this company and still hold that position. Now, this company has gotten absolutely destroyed since the beginning of this year. They were trading at $90 a share, and now they're at $17. So that's like a 70 to 80% drop in the past year for this company. And the main reason for this is even though they're experiencing explosive revenue and earnings growth, they've had a number of credit issues that have resulted in non-performing loans that they are most likely going to have to write off. This has created a pretty big impact, one-time impact on their financials, and so that makes investors panic and sell the stock down to the levels it was at the IPO. And so here's just a chart from their recent earnings where you could see in the second quarter, their total costs and expenses jumped up, financial expenses jumped up, and even though the company has been consistently profitable, they posted a huge loss in that quarter. Right? And again, that is because of credit issues with the company. As of now, they've stopped issuing credit, and they do think that these loans that they've made will affect the financials for another 3 to 6 months, but after that, this growth and profitability should continue. Now, the problem with this company is the valuation is still sort of high. They're still trading at over 7 times sales. And so even for a company that's growing revenues at 30 to 40% a year, 7 times sales is still a lot. I can't even fathom the valuation they were at trading at $90 a share. Right, the fact that the stock can drop 80% and still be trading at over 7 times sales is sort of insane. But this is a name that I will be watching if they continue to drop. If they continue to drop to what looks like an attractive valuation for the level of growth that they're experiencing, this will be one that I may enter a position into. Now, the last company I'm looking at is actually a competitor of StoneCo, that is PagSeguro Digital. Their ticker is PAGS, and they are a competitor to Stone in the digital payment space. Now, what I like about this company is that they have navigated this year better than StoneCo. They have not had nearly the amount of losses in the credit market as StoneCo, even though part of the issue is because of Brazil's new registry system, which means both companies should have been impacted. PAGS has navigated that situation much better. Now, what I also like about PAGS is that they're trading at a much cheaper valuation than StoneCo. They're trading at just over 1 time sales, and they're trading at 37 times earnings, which is pricey, but their expected earnings over the next 5 years is also 37%. That puts them at a PEG ratio of 1. So I've talked about the PEG ratio in the past. I think it's a simple way to value fast-growing companies. And so if the PEG ratio is 1 or under for a fast-growing company, that typically means that the company is attractively priced for the growth that they are expected to have. And so out of these 3 companies, PagSeguro is the one that I'm most interested in at the moment. Again, there are risks. Brazil and Mexico's economies are starting to slow down. The inflation is high, and there are fears that they will enter back into a recession, which may hurt the growth of these companies. But I do think overall, these 3 companies are all very high quality companies, and if you buy them at the right valuation and they continue to execute, the return should be greater than buying similar companies in the US. So that's it for this video. Hope you enjoyed the video and these 3 stock picks. Let me know what your thoughts are on investing in emerging markets, and if you've actually invested in any country outside of the US. So that's it for now, and I'll see you on the next video.